Regional banks have been outperforming their larger cap counterparts in 2022, but what's the outlook for the rest of the year? Leslie Picker is sitting down with Tom Michaud, CEO of KBW, a Stifel company. They're kicking off their Community Bank Investors Conference tomorrow. Leslie.
Hey, Mel, thank you. And thank you, Tom, so much for being here. So clearly a big theme at this conference is going to be the divergence between regional banks and their larger peers. Is past performance indicative of future performance here? Do you think that the key themes that have helped these regional banks outperform is going to continue given just the headwinds on the horizon?
We really do. And the story for the regional banks has been one of revenue growth, because we see a lot of loan growth currently in the market, even though we think it will slow down by year end. But we think that the loan growth story of the recent quarter is still intact. And also the interest rate cycle that we're in right now. The Fed is going to continue to keep raising rates. And that's something that's going to help the banks as they move away from zero with the interest rate policy.
But eventually the concern is that if there's a deep recession or even a mild recession, that credit conditions could worsen from there. So is that a concern of yours?
So I'd say that's the number one concern of investors, is that the Fed's policy is going to drive the economy into a recession. Our view is that with the really large gap in valuation, which for regional banks, it could be the 4 to 5 PE multiple discount from where it normally trades about 40% below where it normally trades on a relative PE ratio. Regional banks have very big dividends. We believe a lot of that pessimism or concern or uncertainty is already in the valuation. And so we think some of the high-performing regional banks, really good companies, excellent management teams, we think you're getting more than paid for that risk that the economy will continue to slow. I don't think the stocks are priced for a crisis, but we also don't believe a crisis is going to happen.
And what about a potential Fed pivot? That's kind of gotten more into the sentiment of investors these days as well. And obviously, lower rates would kind of erase potentially some of the benefit they've gotten with regard to net interest income, which is that profitability that they generate from being able to charge more from interest.
So this whole regulatory pivot thing, I think, is really interesting. In my opinion, the definition of a Fed pivot is two things. It's number one is, and you have to get inside the mind of the Fed and predict the future, which is, has the Fed done a good enough job to break the back of inflation expectations? And then number two is the economy weak enough that they now need to go into accommodation? I don't believe that's going to happen. I know there's a lot of money invested thinking that the Fed's going to be cutting rates next year. I don't personally believe it. And also, if you read the studies that the Fed has published themselves, there was a very interesting one of a couple weeks ago that I read about, which the Fed has said that they really need to stay on task for mission number one. It's very hard for the Fed to juggle a lot of different priorities. I personally believe they are focused on inflation, and I think that they're going to get to a steady state environment with rates before they immediately pivot. Now, of course, if the economy is much worse, that could happen. I personally don't believe it's going to happen.
Mel has a question for you, Tom.
Okay, great.
Tom, good to see you. So what do you make of a 10-year yield that goes from 3.4 to 2.6 in a matter of weeks? And you say that you're most bullish on the spread lenders. This can't be good for them if we're sitting here at 2.6.
Well,
potentially head lower.
So it's an interesting question, because if the 2.6 has embedded in it, now I know that the market, the Fed fund futures, think that the Fed's going to be cutting rates by next year. I personally don't believe that they will. If the Fed gets to a steady level of rates, then that is still going to be good for the regional banks. Because remember, it's not so much our rates, is the Fed funds rate 330, is it 350? It's not zero. We've essentially had zero for years, and the banking industry was not built for zero. So if it gets back to something that's considered more typical, that's going to be an environment where the banking industry is going to be able to operate more efficiently and better. And so that's why we continue to be optimistic about the regional banks.
Tom, thank you so much. Clearly an inflection point for both the economy and all sorts of banks. We appreciate your perspective and breaking it down for us.
Great to be with you.
Mel?
All right. Thanks, Leslie. Thanks, Tom. Good to see you. Karen, what do you think? Anything but zero is good.
Well, I do agree. Anything but zero is good. Actually, this kind of funky inversion isn't terrible either, because it's all about, that the net interest income and net interest margins are improving everywhere. However, we always come to this issue. If the market thinks, inversions are terrible for banks, so we better sell all the banks, I guess it doesn't matter that they're going to be more profitable. I'm still holding on to them because they are going to be more profitable, and ultimately, I think the value will out.
Well, here's one thing that I think the market's underappreciating, and I think it might be a secular trend for all banks, but especially the regionals. The loan growth that's going on in commercial and industrial is extraordinary. Second quarter, you had 5 to 10% commercial and industrial loan growth. I think people are expecting the same for the third quarter. Remember, banks were not lending for a long time. Remember, the whole thing coming out of the crisis was encouraging the banks to lend. I think it's taken a long time to work through a lot of this. I also think that credit dynamics, especially with technology, are giving banks the power to make loans with a comfort zone in addition to their traditional metrics. And I think part of this is underappreciated in the valuation of these banks.
Brian Kelly, what do you tell your two compatriots here?
Well, I mean, I think they're 100% right in terms of the banks are probably going to make more money because they're making more loans. But here's the thing. Making more loans is money creation, which, again, supports the economy, which makes inflation stickier. So if I'm a banker and for 20 years I haven't made any money, I'm going to make every single loan that I can at these rates. So I think that is another reason why the Fed is far behind the curve.
Guy?
BK, man, he is channeling his Chad's Michaels tonight. Goldman Sachs, and we talked about it when it was trading 275. You know, they'll trade their way out of this, and that's proven to be correct. Stock's gone from 275, 330 or so. I think that stock can continue higher. It concerns me, by the way, that JP Morgan is not able to bounce on what's been a pretty good tape.